Owning a home is supposed to be the smart move. Build equity, create stability, protect your family. That's the story every financial advisor, every parent, every piece of conventional wisdom ever told you. Even for most people, most of the time, that story is true. But Henry owns a home, and right now, that home isn't building his wealth. It's holding him prisoner. Henry is 34 years old. He lives in Phoenix, Arizona. He works in software, makes good money, has solid credit, pays his bills on time. In March of 2021, he bought a house. Not because he was impulsive, not because he was greedy. He did the research, talked to a mortgage broker, ran the numbers about 6 different ways, and decided it made sense. The house was $418,000. He put 10% down when he financed the rest with something called a 5-1 ARM, an adjustable rate mortgage. Fixed for the first 5 years, then adjustable after that. His rate was 2.85%. His monthly payment was $1,553. That's not cheap, but it was manageable. And his broker told him what a lot of brokers were telling people back then. Rates this low don't last forever. Lock in now, build equity, and you'll probably want to refinance before year 5 anyway. Henry thought that made sense. And honestly, he wasn't wrong to think that. Here's what was happening in the mortgage market in 2021. The Federal Reserve had slashed interest rates to near zero in 2020 to keep the economy from collapsing during the pandemic. That policy rate filtered down through the entire financial system. By the time it hit mortgage lenders, the 30-year fixed rate had dropped to around 2.9%, the lowest in the history of modern American mortgage lending. People went absolutely wild. In 2021 alone, over 6 million homes were sold in the United States. That's the highest volume since 2006. It wasn't irrational. When money is that cheap, buying a home isn't just emotionally appealing, it's mathematically hard to argue against. Henry wasn't making a reckless bet. He was making the same rational calculation that millions of Americans were making at the exact same time. And then the Fed changed its mind. Between March 2022 and July 2023, the Federal Reserve raised rates 11 times to fight inflation. The federal funds rate went from near 0 to over 5%. Mortgage rates followed. The 30-year fixed, the one that was sitting at 2, to 8 in 2021, climbed past 7%. That's more than double in the span of 2 years. Henry watched all of this happen. He felt the pressure building. He knew his arm was going to reset in 2026. He'd been telling himself he'd figure it out before then. And then March of 2026 arrived. He got a letter from his lender. His rate was resetting from 2.85% to 7.4%. His new monthly payment, $1,572. That's $1,019 more than what he had been paying every single month, over $12,000 more per year. Henry earns around $95,000 a year. After taxes, he takes home roughly $6,200 a month. His new mortgage payment alone would be over 41% of that before groceries, before his car, before insurance, utilities, any of it. He did the math 3 times because he thought he'd made a mistake. He hadn't. So Henry did what any rational person would do. He called his bank. He said, "I need help. I can't absorb this increase. Is there any other option?" And the banker said, "Yes, actually. Let's talk about refinancing." For a moment, Henry felt better. Refinancing is essentially replacing your existing mortgage with a brand new one, instead of being stuck with a rate of 7%, 4% on whatever years remain on your loan. You take out a fresh mortgage, ideally at a lower rate or with a longer repayment term, so that your monthly payments come back down to something you can actually live with. Millions of Americans refinance their mortgages every year. A completely normal thing to do. The bank walked Henry through the requirements. Stable income, check. Good credit score, check. And then the third one, loan to value ratio. The bank needs it below 80%. Here's what that means in plain English. Your LTV is the size of your mortgage relative to the appraised value of your home. If your house is worth $100,000 and you owe $80, your LTV is 80%. Banks use this number to measure their risk. If you stop paying and they have to foreclose, they need to be confident they can sell the house and recover what you owe them. The lower your LTV, the more equity you have, and the safer the loan looks to the bank. 80% is the standard threshold for most refinancing options. Henry asked what his current LTV was, and that's when things went from bad to worse. Phoenix was one of the hottest housing markets in the country in 2021 and 2022. Henry's home peaked in value at around $500,000 in mid-2022. He felt like a genius. And then the market corrected. Phoenix homes have dropped more than 20% from their 2022 peak. A new appraisal put Henry's home at $385,000. He still owes approximately $362,000 on his mortgage. That means his LTV is 94%. The bank needs it below 80. Henry is sitting at 94. He would need his home to either appreciate by roughly $72,000, or he'd need to pay down that much in principal before he even gets close to qualifying for a standard refinance. Neither of those things is happening anytime soon. The bank can't help him lower his payment. They also can't offer him a home equity line of credit. They can't do a cash-out refinance. Because his loan is already nearly as large as the asset securing it, they're not willing to extend any more exposure. Both doors are locked. This is mortgage prison. Now, Henry's next thought, and maybe yours too, was, okay, fine. I'll just sell the house, take whatever I get, pay off the loan, and start over. Let's run those numbers. Henry's home appraises at $385,000. Realtor commission will run about 5 to 6%. Call it $21,000. Add closing costs, roughly $5,000. That's $26 frozen in transaction costs before he touches the loan balance. He still owes $362,000. So after the sale, he walks away with somewhere between a few $1,000s and nothing. Maybe he breaks even. Maybe he's slightly underwater depending on the final sale price. And then what? He rents in Phoenix. A comparable home rents for between $1,500 and $2,200 a month right now. He hasn't actually solved the affordability problem. He's just traded one version of it for another and lost 5 years of equity building in the process. Henry is not alone in this. Not even close. According to data from the FHFA and industry research firms, more than 3.8 million adjustable rate mortgages were originated between 2020 and 2022. Many of them are 5.1 and 7.1 ARMs that are resetting right now or will reset within the next 18 months. And the problem is concentrated in the markets that boomed the hardest. Phoenix, Las Vegas, Austin, Sacramento, cities that saw 20 to 30% run-ups in home values and have since given back a significant portion of those gains. Across the country, roughly 8 million homeowners currently have LTV ratios above 90%, making them ineligible for standard refinancing products. Federal Reserve data shows ARM delinquency rates rising substantially compared to just 2 years ago. This isn't a story about a few people who made bad decisions. This is a structural problem built into the way the market moved during the pandemic years, and it's working its way through the system right now. So what can Henry actually do? A few options exist. None of them are great, but knowing they exist matters. The first is to contact his lender about a loan modification. This is different from refinancing. A modification asks the bank to restructure the existing loan, temporarily reducing the payment, extending the term, or adjusting the rate, without creating a new loan. LTV requirements are less strict because you're not applying for new credit. Not every lender will agree. But for homeowners who are current on their payments and can document financial hardship, worth requesting formally in writing. The second option applies to homeowners with FHA-backed loans. There's a program called FHA Streamline Refinance that allows eligible borrowers to refinance without a new appraisal. That means your LTV doesn't block you, because the bank never reassesses the home's current value. Henry needs to check whether his original loan was FHA insured. If it was, this could be a real path forward. The third option is to wait. If the Federal Reserve continues cutting rates and mortgage rates drift back toward the 5 to 6% range, refinancing options open back up. If Phoenix home values stabilize and recover modestly over the next year or two, Henry's LTV improves. This isn't a satisfying answer, but sometimes the market does come back to you. Fourth option, the hardest one, is a short sale. If Henry's lender agrees, he can sell the home for less than he owes and have the remaining balance forgiven or renegotiated. It will damage his credit significantly, but it ends the trap. None of these feel like winning. But Henry understanding his options is better than Henry just waiting for something to break. The part that's actually a little encouraging. The group of homeowners facing this specific problem, people who locked in ultra-low adjustable rates between 2020 and 2022 and are now hitting that reset window, is a finite group. People who bought after 2023 did so with rates already elevated. They weren't drawn in by pandemic lows. Their mortgages were priced for this world from the beginning. And as we move further from the pandemic era, the wave of ARM resets gets smaller. This is painful, but it has an end. Henry doesn't know yet how his story resolves. Maybe he negotiates a modification. Maybe his neighborhood appreciates enough in the next 18 months to get him across the LTV threshold. Maybe he waits it out, but he knows something now that he didn't know when he opened that letter. He knows exactly why both doors are locked. He knows the name of the trap he's in, and he knows where the possible exits are, even if they're narrow. Sometimes that's where it starts. 1. If you know someone who bought a home between 2020 and 2022, especially with an adjustable rate, send this video to them. And drop a comment below telling me what market you're in. I read every single one, and I genuinely like to know where this is hitting hardest.